to expert advice. There are two types of people in the market. One who want funds and the other who have funds. And connecting the two are private equities. Let's have a conversation with our expert, Professor Sundaram Korivi, about private equities and its importance in the real estate sector. Welcome to the show, sir.
Thank you very much. It's my pleasure to be here.
Sir, as I said, there are people who need funds and there are people who have funds. Connecting the two are private equities. Now our viewers want to know what exactly are private equities, what are their function exactly?
Imagine a situation where the developer, who is a real estate company, wants funds, and if there's an investor who is a high net worth individual, he has surplus funds. It will take a long time for them to find each other. So you have a vehicle known as the private equity firm. A private equity firm essentially can run as a company or it can run as a limited liability partnership. What they can do is, these are pooling vehicles. A private equity firm is a pooling vehicle. That means they collect investment surpluses from high net worth individuals, offering them a piece of the action in the real estate sector.
Okay.
So these are private equity funds. Now the private equity funds collects or pools the investment from various individuals and looks for investment opportunities in the real estate sector. Now what is unique about the private equity investment is, or the private equity company is, they don't invest in only one sector. They also invest in the real estate sector in addition to other sectors like technology companies and manufacturing companies. It so happens in India that because of the manufacturing slowdown in the last 4-5 years, most of their investments has been in the real estate sector. Not only that, private equity companies also invested already listed companies. So it's a very flexible mode of investing. They invest in companies which are listed or unlisted. They invest in companies which are in the real estate sector as well as in the manufacturing sector or the technology sector. So they have the expertise, they have the investment management skills, and they will also have sector specialists or access to sector specialists, which means the board of management of a private equity firm will also have technical experts. So there is a technical assessment of the investment as well as a financial assessment of the investment.
Okay. How and why do you suggest private equity funding in real estate?
As I mentioned, private equity firms are looking for any good investment opportunity based on the credibility, track record of the promoters, potential for the industry, and decent returns.
Okay.
So it so happens that in the last 3 or 4 years, they have taken a fancy for real estate and decent returns have been obtained by them. And in the case of companies which seek private equity, they could be startups or they could be small or medium-sized companies, or they could be large companies, or they could be large listed companies. So for the entire spectrum of companies, those who want to move from the drawing board to the next threshold of growth, or those who just want some incremental additional funds to bring a project to fruit, these types of companies will access private equity. And here also there are two styles. One is you take a huge amount of investment from private equity to take your company to the next trajectory and maybe even listing. So one type of company in the real estate sector is those who are not listed and they get into the listed space. And the other is those who are already listed but they want some quick money, they don't want bank finance, they don't want to do an IPO. So they can do a private placement or a qualified institutional placement with a private equity firm. So it's a quick, easy and flexible method of raising finance.
Okay, that's really great for all the developers and builders out there. Private equity is really a good option to raise money. So what kind of procedures or guidelines a builder or a developer needs to follow when he wants to raise money from a private equity?
Okay, that's an important question. There is an initial dialogue between a private equity potential investor and the investee company, which is the real estate company in this case. during those initial discussions, the private equity company will have certain expectations, and during that dialogue, he will try to see if his expectations are being matched. One is the credibility of the promoter. That is an absolute must. If the company is young or unknown, then it is very difficult to establish the credibility, which does not rule out funding, but it makes the entire venture more risky. Secondly, if he has a track record and if he has an execution record, and if the numbers are good, then the private equity firm may enter into an agreement with the company, and they may not give the entire funding in one go. For example, if a builder needs 50 crore across a construction period of, let's say, 36 months, the entire 50 crore may not come in one shot. They will say, okay, stage 1 we will fund you so much, stage 2 we will fund you so much. And then in the investee company, you can actually expect the private equity company to put 1 or 2 members on the board so that they do monitoring also. Not only that, a private equity firm doesn't just give the money like a money lender. They monitor the project, they offer management advice, and they say that, oh, you need a civil engineer or an architect, we can get you one. You need a good marketing person for sales and distribution, we can get you one. In other words, they are a very active investor and not a passive investor. So they take an interest at the board level, at the management of the company. What I said is a term sheet is the documentation of the expectations between the two parties. The term sheet would say how much of funding is being considered, how much in stage 1, stage 2, stage 3, what are the milestones of the project, and a rough undertaking from the company saying that 3 to 5 years later the company should go for a listing. By that listing period, the company should be able to generate profits so that when you go public, it is a dividend paying company. The profit and loss account is stronger, the balance sheet is stronger. So in every project, the private equity investor expects these things. So this is the manner in which the real estate company should make itself ready. So good governance, potential of performance, and willingness to perform according to the milestones, and a willingness to go public in the given time frame. In other words, to adhere to the terms of the term sheet.
Okay, I hope the builders and the developers who are listening to this program have followed the guidelines that are involved in a PE real estate funding as mentioned by Sundar Kurivi sir. Now it's time for a short break. We'll be back really soon. Don't go anywhere. Sir, we discussed about the guidelines to be followed by the builder. Now, when a PE raises fund for a builder, and what are the factors that a PE follows while raising a fund for a builder?
Private equity firms call for investors at periodic intervals. It is not done on a daily basis.
Welcome back to Expert Advice. Before heading for the break, we were talking about the guidelines and procedures a builder needs to follow while raising fund for his company via a PE. Now, let's take this conversation further by speaking with our expert Sundaram Kurivi. Sir, we discussed about the guidelines to be followed by the builder. Now, when a PE raises fund for a builder, and what are the factors that a PE follows while raising a fund for a builder?
Private equity firms call for investors at periodic intervals. It is not done on a daily basis. So they raise funds at periodic intervals, and they have an idea of their investor expectations in mind. That's their liability side. On the asset side, they'll be scouting for investments. And investment in real estate propositions is one of the potential in the entire portfolio. So private equity firms try to build a portfolio of investments. In the last 3 or 4 years, the experience of the private equity investors in the real estate sector has been good, as I mentioned, because the manufacturing sector has been down. And they've been able to match the expectations of the investors by investing in the real estate. So that's how it happens.
Okay, so you talked about investors. Could you tell us who are these investors?
Yes, there are several types of investors. As I mentioned to you, the threshold investment is 1 crore rupees, which actually puts the small people out, which is a good thing because smaller investors or low net worth individuals, if I may coin a phrase, may not be able to undertake the risks of a project loss and a hit on the portfolio. Now, there are certain offices known as family offices. A family office is a whole family of high net worth individuals, and usually they appoint an investment manager. That investment manager may look at everything including cash flow management. A part of the family office funds may be directed towards private equity.
Okay.
So if the family has access to direct real estate or gold or stocks and bonds, mutual funds, then investing in a private equity firm may also open up a new avenue. For example, about 5 to 10% of a portfolio could be given to a private equity manager, and he will manage the funds. And if superior returns are made, it will add to their overall return. If the returns are inferior, the portfolio does not take much of a damage because it's only a 5 to 10% in this example. So there are family offices and there are high net worth individuals. Sometimes it is also possible that a mutual fund may find it uneconomical to have researchers and analysts in small and mid cap companies. So a mutual fund may dedicate part of its corpus. Instead of investing directly in SMEs, they may invest through a private equity firm. So these institutional investors, family offices and high net worth individuals will have an exposure to SME enterprises through the private equity vehicle.
Okay, sir, what kind of returns an investor can expect from the whole process?
Internationally, private equity firms have given returns of 3 to 6%, which is a very good return considering their borrowing costs. So if there's a carry cost of 1 to 2%, then a return of 5 to 6% is very good. Whereas in India, the private equity firms have been able to give returns of about 13%, 16 to 17% returns in some cases, even when the overall economy was not doing very well. So you can say that the return expectation can be anything between, let's say, 10 to 11% on a conservative basis to 16 to 17%.
Are there any returns for private equities as such?
The private equity firm will get a management fee, and in addition to that, they may also be co-investors.
Okay. Now let's talk about the private equity regulation. So how are private equity funds regulated?
Yes, that's a very important question again. Securities and Exchange Board of India has introduced a new class which is called alternate investment funds. So these are exclusive from mutual funds, these are exclusive from real estate investment trusts, these are exclusive from infrastructure investment trusts. So alternate investment funds are divided into 3 categories: category 1, 2 and 3. Category 1 would be venture funds and private equity funds. Category 2 would be debt funds and infrastructure funds, and category 3 would be hedge funds and trading companies. So within this category, within this alternate investment fund class, category 1 is the alternate investment funds dealing with private equity. So they are regulated by SEBI. So an alternate investment fund has to, like any other intermediary, get registered with SEBI, and then after getting the certificate of registration, they can start their operations.
Okay, so the market in real estate, it's like, the prices always go up, but there are times when prices go down also. So when, transaction is happening between a private equity or a developer or a builder, so does this affect the funding process?
Definitely. Now, as you indicated, there is a risk here, but risk also gives you opportunity. There is a return also available. So the entire theme of investment, like any other investment class, will be based on risk and return. Now, when the real estate sector is heated up, it makes less sense for the private equity firm to invest in real estate. But when the real estate prices are reasonable, or when investment opportunities are available at a reasonable cost, that's when the private equity firm will be able to find opportunities. And let's not also forget one fact, is that the real estate private equity company also has experts in real estate. That is one thing. Another possibility is that a private equity company can always use the services of a registered valuer. Now, that is one new breed of professionals that has been mentioned in the Companies Act. A registered valuer is a valuer recognized under section 247 of the Companies Act. Now, those rules have not yet come, but SEBI says in its guidelines for REITs that until those guidelines are finalized, it would be a chartered accountant. So, if shares are coming at a high price, okay, then the entire underlying business can be subject to a study by a private equity company. They can use the services of a registered valuer and come to their own valuations. So, if the price is right, then what happens is, once the project is done, remember the investee company is a real estate company. He will build the real estate and he will sell it and he will realize his profit. Okay. Then what happens is the share price goes up. So, if the private equity firm is already having shares of that company, holds on for 3 to 4 years, and the share prices appreciate because the flat prices appreciate, then it becomes a good return on investment for his investors. So, that's how the cycle works.
Okay, you must have heard the impact of rising or falling prices on the real estate sector as well as the transactions in the PE. Now it's time for a short break. You don't go anywhere. We'll be right back really soon. So, as you must have heard, the government has relaxed FDI norms, especially, it has a lot of effect on the real estate sector. So, do you think private equities would be affected equally?
Positively.
Okay.
There is a very positive externality arising from the presence of FDI into the real estate sector in India.
Welcome back to Expert Advice. Recently, the Indian government relaxed FDI norms. Does this affect private equities in any way? We will get to know about it from our expert, Professor Sundar Kurivi. So, as you must have heard, the government has relaxed FDI norms, especially, it has a lot of effect on the real estate sector. So, do you think private equities would be affected equally?
Positively.
Okay.
There is a very positive externality arising from the presence of FDI into the real estate sector in India. First of all, this has been put forward by the Department of Industrial Promotion and Policy, DIPP, and when the FDI is permitted 100% in the construction sector and along with it the real estate sector, then the real estate sector gets an industry status, something that it has been craving for the last several decades. So recognition comes to the sector also. Now 100% foreign direct investment in real estate means up to 100%. Let's say a real estate company can co-partner with foreign direct investment entities and get its equity financing. Now foreign direct investment in the real estate sector is actually long-term investment. So a company which has absorbed FDI is benefiting from these two things. When that happens, and if such a company approaches a private equity firm for additional funding or for taking them public through an offer for sale, it becomes a very good thing. Now, as regards the foreign direct investment, several norms have been eased over the past 1 year. Those new rules were eased in the last 2-3 months. One is that there were stipulations which the FDI investors were finding difficult. Those stipulations have been eased. For example, minimum project size 50,000 square meters, that has been brought down to 20,000 square meters. Secondly, there was a scheme that 30% of the area must be for affordable housing. Okay, now 30% is available for affordable housing, then none of the other stipulations like 50,000 square feet etc. will matter. It will be waived off. And also in addition to this, FDI investment has a lock-in for 3 years. That means the foreign investor cannot sell his shares and go away for 3 years. But now it says that if he completes his project, then earlier, then he can exit and sell. Okay. And secondly, if there is affordable housing 30%, then even this 3-year lock-in condition may be waived off. So because of all these three things, they add to a positive spillover to the real estate sector.
Okay, so you said FDI shall have positive effect. But there is another development by the government. They have announced that real estate regulation and development bill will soon be a reality. So why and how do you feel it would be good for private equities?
Okay, first of all, this basic consideration for the Real Estate Regulatory Authority is consumer protection. Because in the normal sense, if a consumer who is aggrieved, he gets bad service or he doesn't get his flat or there's a deficient product, then he may go to the consumer court. And the consumer court doesn't consist of specialists. Real estate and housing projects have their own problems. So if it goes to Real Estate Regulatory Authority, you'll have an appellate authority, you'll have the consumers being taken care of and their needs taken care of in the regulations itself. These are specialized bodies, and every project will have to be registered with the registering authority. We do not know now what the exact structure will be, because at the government level there were proposals to have a Real Estate Regulatory Authority, and in some of the places the policy has said that different states shall have their own regulatory authority. So we do not know whether the central rule will be a model rule which will be adopted in varying degrees by the different states. But definitely the customers are happy. The real estate companies are not very happy because they will be subjected to further monitoring. But those who are large companies, well organized, those who have proper corporate governance, they have welcomed this regulation. And let us not forget, since we are discussing private equity, if there is a real estate regulatory authority, then a private equity company would like to fund real estate even more, because the investee company is answerable or responsible to some regulatory authority. So as a whole, the industry itself gets organized.
In all, it could be said private equities are having a good time now in India. So how do you see the future?
We can say two things. One is that a slew of companies came public from the real estate sector in 2008, and some of them did well, some of them did not do well. So the lessons from that episode are to be learnt. And second thing is, private equity today is much more organized, in the sense it is a part of alternate investment funds category 1. So it is more organized, the regulatory structure is there, and also the lessons from the past have been learnt. Last but not the least, new land parcels have opened up. For example, Air India, Bank of India opening up their land parcels, tier 2, tier 3 towns coming up, and the city center moving away from manufacturing. It gives large parcels of land, for example, the mill land in Mumbai and other factories in other places. So all in all, the private equity sector is more structured, and the lessons from the past will be learned.
We got to know a lot about private equities today, and thank you so much for the same, sir.
Thank you very much.
We shall be back with a lot of information which shall be helpful for you in the long run. Till then, you keep watching Expert Advice and keep watching Spin TV too. Goodbye, take care.